If you've never filed an income tax return, you might be wondering how they work. Well, in this video, we're going to give you the rundown on how Form 1040 works from top to bottom. I'm even going to go over a very simplified example using real numbers so that you understand what causes a person to get a refund versus potentially owe. So make sure you stick around for that. Welcome to Tax Chit Chat, the place where we talk all things tax all the time. So the purpose of an income tax return is to 1. Report your income, and 2. Calculate the tax that's owed on that income. The starting point of the return is with your income items. This can be wages that you earned from a job. It could be interest. It could be dividends. And all of these things are going to get reported to you on various IRS forms. Now, these forms are going to be sent to you around January 31st of the year following the year that you're reporting. So we're in 2022, which means we'll be working on tax year 2021. So around January 31st, we'll get W-2s, 1099 INTs, and 1099 DIVs. Wait, Jared, I don't understand any of these forms. How do I put those onto the tax return? Well, don't worry. In our very next episode, we're going to walk you through how to file an income tax return for the first time. So make sure you come back. And if you're watching this video after we've made it, it'll be linked up here as an info card. All right, so now that we have the income out the way, the IRS is going to allow you certain deductions or adjustments. So, did you pay student loan interest? Did you pay for supplies as part of your job as an educator or a teacher? Did you make contributions to a retirement account? Well, all of these things are subtracted from your income to arrive at our next number, which is adjusted gross income, or AGI. So AGI is just that. It's the adjusted income number. We take the income, make those subtractions, and we get to AGI. From here, the IRS is then going to give you another set of deductions. So things that you spend money on, such as charitable contributions, property taxes, mortgage interest, state taxes taken out of your check, medical expenses, all of these things are allowed to be deducted from your income. So here's where the IRS does you a solid. The IRS will allow you to either take what's known as a standard deduction or these itemized deductions. Everybody's filing status, single, married filing joint, has a certain standard deduction number associated with it. So if your itemized deductions exceed the standard, then you itemize. If the standard deduction is greater than your itemized deduction, then you take the standard. Once you subtracted your deductions from your adjusted gross income, you now wind up at another number, which is your taxable income. And this is the number that your tax is actually calculated on. The calculation is based off of your filing status as well as how much income you've earned. So the more income you earn, the more tax you pay. The less income you earn, the less tax you pay. From this taxable income number, once your tax is calculated, you are then allowed to take what are known as credits. And credits, the only thing you really need to know is that they are a dollar for dollar reduction in the amount of tax you pay. So if you have $1,000 worth of tax and you get a $600 credit, your tax now goes down to $400. Once you arrive at this number, which is known as your total tax, you're now going to determine whether you get a refund or you have a balance due. And it's really quite simple. If you had more income tax withheld throughout the year than the tax, you get a refund. If you had less tax withheld than the tax, then you have a balance due. In order to solidify all of this, let's run through a very quick example. Let's assume that at your job you earned $50,000. That $50,000 is going to be reported to you on your W-2. From there, let's assume that you paid $500 in student loan interest. That gets subtracted off. You're now at $49,500. This is your adjusted gross income or your AGI. From here, you're either going to take the standard deduction or itemize, and let's assume that you're single and you're just simply going to take the standard deduction. So we subtract off $12,550. You are now at $36,950. That's your taxable income. This is the number that your tax is calculated on. So now what we have to do is we have to calculate the tax. Now I'm a tax professional, so don't worry about the calculations, but I know that you're in the 12% bracket being single with this dollar amount. So we multiply by 12%. I have to do a little bit of other math. Then you wind up at $4,235. This is your tax. Now, let's assume that you had a credit. So you recently graduated from college. You had to pay for all of your education on your own. So you're going to get an education credit. We're going to subtract that off. Your tax is now $1,735. This is the amount of tax. Now, do you owe or do you get a refund? Well, that depends on how much money that you had withheld. Let's assume that you had $3,000 taken out of your check. $3,000 minus the $1,735 in tax, you're getting a refund of $1,265. But let's just say $1,735 and you only had $1,000 taken out, unfortunately, sorry Charlie, you owe $735. And that, in summary, is how the income tax system works. The key takeaways for you is that deductions reduce your taxable income. However, they don't always result in a refund. Credits are the holy grail of taxes. They reduce your taxes dollar for dollar, so whenever you can get a credit, make sure you take it. And make sure you pay enough into the system over time. Whether that's through withholdings on your job, or if you're making estimated tax payments, make sure that you have enough taken out. Otherwise, at the end, you're gonna owe. And you can always adjust your withholdings via Form W-4. So until we meet again, friends, remember, keep earning, keep learning, and just like that, this chat is adjourned.